Let's get into then the cross-border deal conversation. And what I want to do to keep us focused is kick off this next session, which look at outbound M&A. So quite often the mandate, we believe, from many boards is buy innovative companies and buy overseas, buy international, expand the breadth and depth of the portfolio. But these are far more difficult deals than buying a company in Michigan. When you're buying a company overseas, the rules, the challenges, the risks are significant. But we all, I believe, need to elevate our aptitude in terms of being able to do these deals effectively. And boy, are we fortunate to have one of the preeminent M&A advisors in cross-border deals, George Casey, here with us today, and he's going to walk us through this next session. So welcome, George, and to the panel.
Thank you, William. Good afternoon. Well, good morning still. Maybe I'll ask the panel to introduce themselves. The topic today will be, what we will be discussing is cross-border M&A, and we will try to, in the 45 minutes that we have, try to highlight some of the challenges and issues that we see in cross-border deals. We would very much welcome questions as we go along so that we can actually get into more interactive discussion. But before we go there, maybe let's quickly introduce the panelists. Brian, do you want to go first?
Sure. Hi, I'm Brian Hanigan. I'm the VP and Associate General Counsel at IDEX Corporation. We're based up in Lake Forest, Illinois. We're a diversified industrial manufacturer. Have about 45 to 50-ish operating companies throughout the world, about $2.3 billion in revenues, 9-ish billion market cap. And we've done a fair bit of international M&A the last 3 years. I think 4 out of the 5 acquisitions we've completed have been international companies, and then also a few companies on the divestiture side we've sold in Asia and in Europe last year.
Good morning. I'm Scott D'Angelo. I'm the Vice President, Deputy General Counsel at Fortune Brands Home and Security. We're headquartered here in Deerfield, just north of the city. We're a holding company for a number of different building and home products brands, Moen, Master Lock, a large cabinetry business. We're about $6 billion in revenue. And I've been there for about 3 years doing primarily M&A work for them, as well as helping to manage the legal department. As Brian mentioned, our acquisitive strategy over the last 3 years has been largely international, both in the UK as well as other jurisdictions. So we've done a lot of cross-border work. Prior to that time, I was with McDonald's Corporation for about 13 years as well, where I worked both in their London offices and in Singapore, and was responsible for a lot of their divestiture and acquisition work for them over the time I was with McDonald's Corporation. So pleased to be here.
John.
Great. Hi, I'm John O'Brien, responsible for corporate development at Brooks Automation. Brooks is about $2 billion now in market cap and about $600 million in revenue. 80% of our business is semiconductor capital equipment. The other 20% is life sciences. We've completed, in the last 7 years, we've completed 2 deals in the UK, 1 in Germany and 1 in Japan. We've got an LOI for another UK company in place, and we're looking to make a bid for a Switzerland-based company as well. So we've got some cross-border experience in my company as well.
And I'm George Casey. I'm a practicing lawyer. I'm partner at Shearman Sterling. I had the global M&A practice at the firm. I have done deals pretty much in every major jurisdiction over the years. I also teach. I'm a adjunct professor teaching M&A, cross-border M&A at the University of Pennsylvania. Hopefully we will give you some insight into some of the cross-border topics, as I mentioned. And maybe we'll start with macro, kind of high-level view of the current M&A markets, although we're not going to spend much time on macro because it actually, the most interesting part is really talking about some specific things and type of things we get into when we do deals. At the macro level, the M&A markets, as we all see, continue to be challenging. On the one hand, we see significant volume in terms of dollars, yen, euro spent. On the other hand, we also see relatively flat market in terms of number of transactions. So what it suggests to those of us who pay attention to the markets is that market practitioners are focused. They are focused on specific opportunities, but they are not rushing into deals. Where we see more activity these days is actually in the US, partially because The U.S. economy is probably more stable now than some other parts of the world. And although we may argue that it's not as predictable, but it's probably a little bit more predictable than some of the European markets. So there is quite a bit of money going into the U.S. We also see quite a bit of outbound U.S. M&A, partially because dollar is strong, and strong dollar allows U.S. market participants to go and find good opportunities, particularly in Europe, where both the combination of the currency, the exchange rates these days, but also where in some of the markets valuations are depressed because of uncertainties in those markets. So again, not going to spend a lot of time on the markets, but looking at M&A as part of the corporate strategy. John, maybe starting with you as a business development practitioner who is surrounded, by the way, by lawyers, for better or for worse. But looking at it as a business person, right, from the corporate development point of view, how does cross-border M&A fit into the corporate strategy? How should people think about cross-border M&A compared to domestic deals? Does it matter? Or maybe it doesn't matter? How you guys look at it?
Yeah, so I think, so first of all, M&A is an important part of our strategy, generally speaking. We articulate it as part of our strategy to the street. Our board is very supportive of M&A, so it is a big focus of ours. We're a global company, and so when we think about M&A, we think about it globally as well. There are certain countries we would probably avoid, but for the most part, if there's a company that makes sense for us, a target that makes sense for us from a strategic perspective, we're willing to go to any country to acquire a business.
So do you look more on a product by product basis or business line by business line, or do you look at geography as a strategic prerogative?
Yeah, it's more product line, the business, and then we'll assess the country. But its first order priority is the strategic fit and what the business does. If it's in a country where we don't have a footprint currently, we'd probably think harder about it. But we haven't done one of those yet.
Right. So. Right. Okay. And when you think about assembling the team, Brian, when you look internally, externally, so you venture into a country where the company may not have ventured before. How do companies go about it? How do you assemble the team? How do you try to identify the internal expertise, outside help if you need it? What's the thinking there?
Yeah, I mean, sometimes that's a challenge for us because we've got a very small legal department, small business development department as well. So especially if it's an international deal, we're really reliant on our outside advisors to a certain extent. And it's challenging on the legal side, especially if you're in an auction process where you don't have a lot of time to get up and running to identify the critical stuff that needs to get looked at. So it's very important to have the right legal counsel in country. And one of the challenges we face, just for example, a couple of deals we did were in Italy and Germany the past couple of years, where we didn't have anybody on our team in our corporate office that spoke the language. And kind of the space that we play in M&A is in the $50 to $250-ish million businesses. So kind of private equity owned or family owned businesses. So it's not necessarily a division of a public company where you'd have local folks there, more of the documents in English. So I need to get out in front of that and be in conversations with our legal counsel to say, hey, here's what we need from you. We don't want you to translate every page in the data room because 80% of that stuff is worthless anyway, right?
Right.
But I need you to focus on these particular things. And what we found is sometimes the law firms have a different idea of what legal due diligence is. I mean, they're very good at telling us if there was a share transfer 25 years ago that wasn't updated properly in the register, or they don't have any claims that are outstanding. But what we really need their help on is more of the commercial sort of stuff, reviewing employment contracts, reviewing commercial agreements, that sort of stuff. So it's you really have to give them a roadmap so you get the right work product and you're covering the critical areas.
Right. And then we'll talk a little bit later today a little bit about cultural differences. And so to Brian's point, you sometimes run into cultural differences even in how people do deals, right? Because it's a very different, sometimes very different dynamic. What we find is that often when we help with deals in jurisdictions that may be less known, it's very helpful to have a financial advisor or consultant who actually knows the country and knows and can navigate some of the both cultural but also deal dynamics with the counterparty and then with local authorities and so forth. On legal counsel, similarly, some countries have very, very sophisticated law firms, very sophisticated and very experienced lawyers. Some countries less so, and so we sometimes find ourselves where we do the global deal and then we have local counsel working with us because they would not have as much experience. And again, we'll touch on some of the differences. In some countries, people would expect that the purchase agreement will be 5 pages long, right? And it's not a question of length, it's a question of what's in it, right? So, and you end up actually going into some much more detailed discussions than maybe people are accustomed to. So maybe switching to some of the more detailed, more interesting topics on what type of things we actually run into when we do cross-border deals. And so when we look at cross-border, there are some countries where you do full-blown acquisitions. That's sort of as part of the corporate strategy and actually feasibility. You go into the country and you look at just acquiring a company, public company, private, and so forth. In some countries, not so much. Sometimes you say that, okay, here we'll do a joint venture. Scott, what's any thoughts on when companies, and drawing on your experience and living and practicing actually in a number of countries, how should people think about full acquisition versus joint venture versus maybe minority investment, something else?
Sure. Yeah, and in the experience I had both in my current role and at McDonald's, a lot of experience with joint ventures, and I can tell you that most of them were not pleasant. And these were joint ventures that were in place that I ended up inheriting and managing that had been put in place early on, and I would say mostly for McDonald's as entries to certain markets where they wanted to get access to the consumer base, didn't really have the assets on the ground or the resources on the ground to do it. So finding a local partner who, for example, and with McDonald's, a lot of it was about real estate and location. So it was finding a local partner who had the bandwidth, who had the experience and the connections in the local market to find locations to establish restaurants. And while on the front end of that process, very positive, also a way to get in the market the right way for them. Over the long term, I think the experience, I would say, is largely negative in the sense that, especially in emerging markets, less mature markets, they experienced a great loss of control over the brand and the way that the business was run in those markets. And to the point where you have someone who's controlling the real estate and making it very difficult for the multinational to come in and do what it wants to do with the brand. So I think that, my view on that is that I think I would almost take the position in today's environment that you're better off going in with a direct investment buying than you are doing a joint venture, especially in emerging markets, unless you're really prepared to take the risks around the loss of control, the way that your local partner is going to run the business in that market, and what the structure and the legal structure is like in those markets. Because not surprisingly, in certain emerging markets, it doesn't really matter what you write in your joint venture agreement. You're not going to, you're going to have a very difficult time enforcing it, particularly exit provisions and trying to buy out partners. Much more difficult than what's written in those agreements, particularly in, depending on the jurisdiction you're in. So my current instinct and feeling is that you're much better off with a direct investment because it gives you the control, it gives you the ability to control your brand and what you're doing in that market. As well as, I would add to that piece as well, the compliance risks, again, in today's environment. You've got someone operating and representing your brand in those markets where you don't, again, necessarily have that day-to-day control over what they're doing. So while I think there are some positives, I would say largely, my view, and I think what we've been doing in my experience the last few years is a lot more direct investment than a joint venture structure.
And on some of these challenges that you just touched on, Scott, when you are actually negotiating joint venture, what works, what doesn't work? What should people keep in mind when they're actually going into negotiating a joint venture?
Yeah, well, I think one of the biggest things is in negotiating is how are you going to wind it down? What's it going to look? What's the time horizon? What's that going to look like? And what are the levers you're going to put in there to exit out of that investment at the time, at the appropriate time? And while we've negotiated various buyout formulas, appraisal processes, all of those things, I think it's important to think about what would work would be exit strategies on the timeline that you're looking at, using as much as possible independent arbiters of the value of that business in a way that's removed out of that jurisdiction, out of the local jurisdiction or market where you're at, so that you feel like you're going to get some level of independence to that process. And then I also think, if you find the right partner, I mean, and that to me is what works is spending the time on the front end of that process, finding the right partner, spending the time to do the due diligence, find the right partner, and when you do that, negotiating in from an operating standpoint, how are you going to, leveraging that party's strength, but doing it in a way that doesn't necessarily dilute your control over the business. So, I think playing into your counterparty's strengths and structuring the agreement in terms of the operating piece that way is also a positive.
And that's actually very similar to my experience in joint ventures, where it's so important to think at the front of the process as to what it is that we are trying to achieve, who the partner is, and then actually, as painful as sometimes it may be, negotiating the nitty-gritty, the details of the partnership going forward. And the interesting thing here is not so much even legal issue or business development issue, it's a psychology issue, right? When you have a partner you like, and both partners are going into the joint venture thinking that, well, this is great. We're going to live together for the next several decades. It's a joint enterprise. Let's not worry about these details, right? Let's not worry. We'll figure out how we're going to operate it, or we'll figure out why do we need to talk about exit? Why do we not? I'm not planning to exit, and the partner is not planning to exit. Why we should even spend time talking about it? The unfortunate thing is that once you get to operating, or once you get to an exit, sometimes the exit may be a year away, sometimes the exit may be 50 years away. At some point, there will be an exit. Not negotiating it up front would mean a lot more pain down the road.
Correct.
Maybe the only other thing I would say is in these negotiations also, it's to some extent when you buy and sell, there is a finality to the partner's thinking. The buyer thinks, well, we're going to sign this deal, we're going to close and move on. The seller thinks the same way. In joint ventures, sometimes people pay less attention to how we're going to actually form the joint venture and what goes into what people refer to as formation agreement. You can call it contribution agreement, but it's basically how the assets are going to come into the joint venture. And that's another piece that is very important to pay attention to. I can tell you, we were negotiating a joint venture. It took us about 11 months to negotiate. We signed it. There was no doubt in anybody's mind that we will close. 3 weeks later, our counterparty said they're not closing. And so then all of a sudden, what's in the formation agreement, the legal obligations in the formation agreement, and what the consequences of not complying, that becomes very, very important. And that's where everything that's been negotiated gets under the microscope. In that particular transaction, we actually brought the arbitration claim. Took 3 years to arbitrate, and I can tell you as a transactional lawyer, sitting under the microscope for 3 years, where each word in that agreement is been reviewed, it's quite a process. But at the end, we prevailed, we won, we established that the other party should have closed. We collected very significant amount of damages for the client because the counterparty did not close. But the only way you can do it is when actually during the process you are very focused on negotiating things that otherwise may feel like, well, we don't need to spend time on it. Switching from joint ventures to different deal structures. Cash transactions versus stock transactions. John, do you want to talk a little bit about how people should think about it, particularly in cross-border context? Is stock a realistic deal structure? Is it more likely, that parties will use cash? How are you guys thinking about it?
I think generally speaking, cash is easier than stock, and the same issues you have domestically with a stock deal you have internationally, even more so because they may or may not be familiar with your stock or your business, and so that the reverse due diligence required in order to do a stock deal would just slow you down, and it's hard. It's a negotiation on how to value your own stock to begin with. So we haven't really even considered it.
Right.
All of our deals have been cash.
Right.
Yeah.
Okay. Yeah. Have you guys, probably there is quite a bit of experience and concerns about where cash sits, right? These days, there is, for U.S. companies in particular, there is a lot of cash that's trapped abroad. Would have been great to bring it back or somehow use it. How do you guys deal with it? Do you find that you can use your cash outside of the U.S. or?
Yeah, I mean, it's a huge selling point for the cross-border deals with our CFO is we've used cash that's trapped overseas to do these acquisitions. So it's definitely a benefit to doing a cross-border deal. You know, that Japanese deal, we were able to use cash that was trapped in Korea. The UK
So
deal,
cash was actually in Korea, but you were using it for the deal in Japan, right?
Yep. And similar with our European deals. It's not always in the UK, but we've done 2 UK deals, and I think it was in Luxembourg. So again, tax department and CFO like to use the trapped cash, so it's been a benefit.
Yeah.
Right.
Same situation with us.
That you guys would prefer to do cash deals?
Well, it just happened to be an advantage to us in the deals we've completed in the last couple of years. We did have the cash over in Europe we were able to use.
Right. On stock deals, maybe just to elaborate a little bit, not going into technicalities of securities laws, but needless to say, whenever you use stock, right, you need to then go through some equivalent process equivalent to U.S. registration, right, where you need to qualify that stock in the country where you're going to be distributing stock, and it may be not even one country, it may be multiple countries. So thinking about that and planning for that and planning in terms of the timeline for that is important. And then also, once you start valuing stock that's trading in different currencies, you start running into how you exactly agree on the exchange ratio and how you then adjust the exchange ratio. So you would have quite a few issues around stock deals. There are plenty of cross-border stock deals. They are done. It's slightly different planning, and you need to assume a different timeline for those transactions. You also need to assume that there will be different accounting requirements, different requirements for financial statements overall. In some jurisdictions, you will need to have accountants do very close diligence on the numbers and actually sign off, more so even than on US-style audited financial statements. So in some countries, you actually need to have accountants sign off on the numbers you put in your press release about the deal if you are starting to highlight those numbers. So those are the type of things to pay attention to.
And I would just add too that our experience, we've modeled that in a few transactions that we've tried to do recently, and where it made a lot of economic sense and actually I think would have made the deal very attractive to us, but we found it ends up being it ends up being a derailer, and unless you're dealing with a counterparty that's very prepared to really do the diligence and look at it the right way, it ends up really it's slowed down our process, and we've ended up having to ended up going back just to cash deals for the most part.
Right.
Yeah.
Right. Going to some other aspects of deal structures and what it is that we are seeing in deals. And sometimes, by the way, it's fascinating when you go into a particular jurisdiction, all of a sudden, you realize that the market, quote unquote, what is market in that jurisdiction is very different from the US or some other jurisdiction you may have dealt with. Some of the issues come up in things like when you shift actually risk. So in the US, we're accustomed to that title passes at closing, right? So you sign the deal. You may spend multiple months sometimes getting your regulatory approvals, and then only at closing the risk actually shifted, or the risk of change in value shifts at that time. Not so much in some other jurisdictions. Brian, do you want to talk about some structures, like, for example, Lockbox?
Yeah, sure.
Some people may have heard about it, some people may not have.
Yeah, so I think increasingly in the European market, particularly private equity-owned businesses, they're moving more to what's called a lockbox structure, where you value the business based on a balance sheet as a particular date, say June 30th. That's your purchase price, and then any fluctuation within the net debt and working capital throughout the period between when you sign the purchase agreement, when you close, or actually between that balance sheet date and the close is what it is. As long as there's no sort of kind of funny business, taking cash out of the business. Right. And that's much different than what we're used to in the U.S. In terms of having a purchase price and then a working capital or a net debt target where you'll adjust some period after closing. And in our case, where we've accepted that in a couple of deals, I think it's been advantageous to us because it's something that the sellers want to do. They prefer the certainty of getting their money, not having to fight with the buyer about what what the final working cap is to go through that prolonged process and waiting for the rest of their money. So.
Right. And a locked box is a structure that's actually is considered to be market structure in Europe, right? So in the UK, for example, but even in continental Europe, it's very much the prevailing structure, right?
Yeah, and along with that, because you're basically buying the business as of that date, and the view of the sellers is that the risk transfers during that date, they're very reluctant to include any sorts of closing conditions or a MAC out or anything like that. Their basic philosophy is, hey, the only condition is whatever regulatory approval needs to come through, and you bought it as of that date. Yeah. So we've had a lot of difficulty in getting any sort of additional closing conditions pushed in. A couple cases where we have had some success. It wouldn't necessarily be just a general MAC out. They've actually been more receptive to putting some sort of a number around it, just so they'll know, hey, if there's something that has a $4 or $5 million impact that we can quantify it, we're okay with that as a closing condition. Right. So that's where we've been able to kind of get around that reluctance.
Right. And so the main difference between locked box and how we're accustomed to doing it in the US is that effectively the seller, quote unquote, sold the business, not even at the time of signing, sold the business as of the time when the locked box financial statement was prepared, right? So you may sign today in September, right? But the financial statements were as of June 30th,
even January, in some cases.
Right? And so you sold the business as of that time. Now, for the seller, and that's the reason why actually this structure evolved in Europe, for the seller, it's a very advantageous structure because they basically say, here's a set of financial statements. You, the buyer, value these financials, not just financial statements. You value on the business plan, do your evaluation as you need to do it. We agree that the price for the value for this business and the price that's going to be paid is X. And effectively, you, the buyer, bought the business as of that time, which, to Brian's point, goes not only to value shift. So if something changed, maybe short of fraud or some major events, but even MAE, which we can touch on, even MAE will not likely fall into that category that the deal is not going to close or the value will shift, right? And then if you're basically waiting to get your conditions satisfied, you go through the regulatory process, closing comes, money changes hands, but the business actually, the risk for the business shifted as of that time. Now, as a legal and financial matter, what then you need to do is you negotiate as to what is the cash in and cash out of the business, right? What happens, because locked box effectively means that you're truly locking that box. The business is closed, and whatever earnings are coming out of the business, they are sitting at the company for the benefit of the buyer. Whatever the expenses are at the buyer's expense. So you spend quite a bit of time negotiating what the seller may or may not do with respect to the business, what kind of cash they can take out, and if they take it out, then you obviously adjust what kind of expenses they should run, but otherwise, the business is locked. Other value issues, John, that you come across and you think about when you negotiate a cross-border deal?
Yeah, so we have not used a lockbox. I think that's interesting in our UK deals. It's been proposed, but we've been successful in negotiating a traditional working capital mechanism. So I think it just depends on the situation. One thing that I think is interesting is this transaction that we're in LOI in for the UK company. We're going to use warranty and indemnification insurance, which is the UK version of reps and warranty insurance. And there appears, at least through our lawyers, we got 6 different brokers to submit bids for a $65 million deal. So there seems to be a pretty vibrant market in the UK for that insurance, and it's in this transaction, it's a nice mechanism for us. And the seller agreed to split the premium with us 50-50.
Right, right. Brian, going back to things like MAE, right? What's your experience? And we can compare our experiences on this panel with MAE, how it's negotiated, what role it plays in other jurisdictions.
Well, fortunately, it's never been implicated in any deal that we've done. But as I mentioned a little bit before, the way we've tried to get around the seller's kind of flat reluctance on having any sort of standard MAE clause is to have something in there that gives us some protection, right? That if there's an event that results in a loss of business or damages of X amount, then we'd have the ability to walk away from the deal. So I mean, it's not perfect, but at least it helps us sleep a little bit better at night. And fortunately, the deals that we've done, we haven't had a long period between sign and close, or any issues that would draw that out. So that's how we've attempted to attack it.
Right. But my experience is that in the U.S. we view M&A as sort of last resort, and very unlikely that a Delaware court, for example, will find an M&A. Right? All the case law shows that. Even in some extreme circumstances, it was not an M&A still. But if we look at the UK market dynamic or continental Europe, there you would probably find it even more seller-friendly. Yeah. So it even less likely that the court will find an M&A. And in the lockbox structure, going back to lockbox, very often the market expectation, and so accordingly the seller's expectation, would be that M&A is not closing condition, right? So actually, as a U.S. firm coming, or as a U.S. practitioner coming with U.S. client into UK to negotiate a deal, you actually will have an uphill battle arguing that M&A should be a closing condition. They would say, well, no lockbox, so you have it, right? There is no M&A. And so once in a while you may be able to get there, just negotiation dynamic, but the expectation would be actually not to have it. So then maybe some other closing conditions. Scott, do you want to talk about some other things that you may have seen in closing conditions, what the expectation would be, what the typical seller outside of the U.S. would want or not want?
Yeah, I mean, well, my experience generally has been, that it's a lot less than more in most of the jurisdictions outside the U.S. because of, I think, the general view that as you mentioned, on the continent, the lockbox market practice, and that was my experience as well as with you in one deal I did recently in the UK, where we were able to get a pound sterling figure on a couple of specific events that gave them some comfort, but very difficult. I've had a difficult time negotiating other closing conditions beyond just regulatory approvals. Sometimes, depending on the nature of the business, we've had a deal that we did last year in the UK. We had a couple of major contracts that had change of control clauses in them that required certain consents that we absolutely had to have because if the business was going to go, if that customer business was going to go away as a result of this acquisition, then the business wasn't going to run the way we wanted it to. So we had a major, the deal almost fell apart as a result of this, but we held firm on the need for these consents prior to close from these customers, which we were able to get without a lot of heartburn. One obviously negotiated in some increases in their purchase price and structure of their contract, but we absolutely had to have those in order to close. So beyond specific dollar value or pound value, euro value events, my experience has really been mostly around consents in terms of those closing conditions. Right. Otherwise, it's been not a lot, not the same way it would be in the United States.
Right, and generally going along the same issue that we discussed before, where it tends to be more pro-seller. You will see Correct. Much less in terms of conditions in deals outside of the U.S., particularly in Europe. So, for example, sometimes what we take for granted in the U.S., we would probably negotiate about bring down of reps and warranties right. only, sort of how do you qualify them, and it's really not much to say. We view it as boilerplate. You go to the UK or to continental Europe, they would actually say, no, well, there is no such thing as bring down. Why would we, what they call, repeat the warranties right. At the time of closing? And you look at them and like, well, but we do need to know that they're true, right? And again, the expectation, and that's actually one of the fascinating things about cross-border deals, is the fact that people are coming from completely different perspectives and different experiences. They would say, well, no, we will not, quote unquote, repeat warranties at closing. By the way, I use the term warranties because even there you have cultural difference and market difference, actually even legal difference. In the US, we call them representations and warranties in one breath, and it means one thing, although technically you could argue that 200 years ago maybe there was a distinction. If you go to the UK, actually they will not call it representations and warranties, they will call them warranties. And the reason for that is that if you call something representation, and that representation is breached, it has a very different legal consequences under English law as opposed to under the US law. So even there, you will see a little bit of a difference. Now, generally, we're not going to spend a lot of time on reps warranties and how the agreement is written otherwise, but you will see differences even in how the representations and warranties, some of the covenants are written in agreements. I'll touch very quickly on public deals, and not going to spend a lot of time. This is a topic in itself. When U.S. companies are looking at public deals outside of the U.S., that's the area where you need to be particularly mindful of the fact that things would be very, very different in other jurisdictions. So, for example, in the U.S., we effectively have two main structures, right? It's either long-form merger, meaning the two companies agreed on a merger, right? And then there is shareholder vote and the merger happens and we are done. Or we use what's called a two-step transaction. There is a tender offer, and typically in the US, you go for majority in a tender offer, 50% plus one vote, so that you get it, and then you can do your effectively squeeze out of the remaining 49% of shares in a very simple process, particularly in Delaware, right? Not so in any other part of the world I can think of, actually. In most of the jurisdictions, you need to go, first of all, merger as a concept exists, and when you talk to practitioners on continental Europe, for example, they will tell you, yes, there is merger as a structure. That's not the merger as we understand merger. The only merger that continental European law recognizes is a true fusion, right? It's, and the French term for it actually is fusion, which is a stock-for-stock transaction where the shareholders of the two companies become shareholders of the combined company. That's the only merger they recognize. None of the cash mergers or some different consideration that shareholders of one of the companies may receive. And accordingly, this structure actually is very rare in Europe. The typical structure would be a tender offer, but guess what? There is a significant difference because there is no back-end merger, so you cannot go for 50% plus one share. You typically need to go in France, for example, for 95% tender for you to be able to do the squeeze out of the remaining minority, minority shareholders. In some countries, you may get to 90, but you will never be at the low threshold as in the US. Now, again, showing the differences. In France, actually, you can squeeze out the remaining 5%. So when you get to 95%, only if the company is listed in France. So there are a number of French companies that actually are public companies, but they are not listed on Euronext Paris. They are listed in the US, right? If they are listed in the US and not in France, you actually will not be able to do the squeeze out. The only reason I'm giving these examples is whenever you are going with public deals outside of the US, it's going to be a completely different ball game, and it's very important to go back to the basics. And sometimes if you're working with local lawyers and there is no international firm that's involved, they may not think that they need to raise these issues with you. So ask the question, right? Educate me on your process and how it works, because again, our expectation will be very different from the way the market dynamic works. Needless to say that when you do public deals, if you go hostile outside of the US, it's yet another completely different dimension. Going into some of the regulatory challenges, other type of consents, third parties we need to deal with. Scott, a little bit about antitrust approvals and what people see in kind of antitrust approvals these days.
Sure. Yeah, and I think that the first thing I would say about that is to Brian's point, I think key in terms of understanding those antitrust approvals is really having the right local advisors on the ground in the market that you're dealing with. Because while many, you've got, and I think about it in three buckets of and I'll speak just outside the US, Europe, Asia, Africa, very different experiences in all of those markets. In many ways, while much of their legislation is patterned, for example, in Asia and Africa, much is patterned off of EU and US antitrust law, and their processes are similar. Typically, the lead times and the process times are much longer. The level of sophistication isn't quite the same, and they're also pulling in a lot of extraneous considerations which don't really fit into the to a typical antitrust analysis. So, for example, in China, my experience has been there's a lot of extraneous discussion and analysis of whether something's in the public interest or in the national interest, and how you try to proactively address that. I think is critical. So in China, for example, trying to formulate that strategy on the front end of the process so that you can really understand what are the kinds of issues that are going to come up as a multinational going into that jurisdiction, and seeking that kind of approval is critical, because it isn't necessarily always going to be a strict traditional antitrust analysis. Same thing with, I did a deal several years ago in South Africa. It was a similar thing. And it was critical for us to have a local advisor there who could sit down with the Ministry of Commerce and really talk about what the economic and, frankly, tax benefit was going to be to the local authority there of the particular deal that we were doing. That ultimately helped us get across the line and shorten the process. So I think that I would say, particularly in China and in Africa, for example, my experience has been the processes are becoming more sophisticated, becoming more lengthy and more detailed than perhaps in the past. And so I think it's critical to really make sure that you're building that timeline into your overall deal process. And I know, particularly in my company now with our CEO, when we're ready to start doing a deal, he sets very, very short timelines, and it's very important to sort of manage that expectation up front about the fact that in these emerging markets, you can't expect that the process is going to move the way it is. And I would add to that as well, in certain jurisdictions in Africa, for example, trying to manage currency control restrictions as well. That's something else that, in addition to antitrust, is something we've had to address as well, is how we're going to get money in and out of that market. Do we have to go on the front end and get approval? What is that going to look like? How are we going to structure it and position it? So all of those sorts of considerations are important to making sure you're setting the right timeline for when you're going to get your transaction.
And about currencies, just a funny anecdote. In some countries, you cannot actually give the shareholders, local shareholders, any foreign currency,
Correct.
right? So in one transaction, believe it or not, in one transaction we had public shareholders, small set of public shareholders who were holding Zimbabwean depository receipts in the company. So we needed to figure out how we're going to give them proceeds, because they are not allowed under the law in Zimbabwe to receive those proceeds. Correct. So we had to create a whole structure around it. In some countries, and we're not going to spend a lot of time on this, you also need to go through foreign investment approval, right? So Scott touched on it. In some countries, it's actually mandatory. In some, it's less mandatory. But maybe we are tight on time. Brian, do you want to talk a little bit about something outside of the government, Works Council, so labor approval, right? Mm-hmm. Again, something that, in this country, we are used to dealing with labor unions, and we know that sometimes it can be challenging, and sometimes in deals it can be challenging. Mm-hmm. But what's the experience in other parts of the world?
Yeah, sure. So our experience primarily in Europe, in Germany and in France most recently, we've had transactions that in order to close, you need to get the opinion and advice of the Works Council before you're enabled to close a transaction. And it's interesting because the opinion doesn't mean that they have to give the transaction a thumbs up or a thumbs down. They just have to issue what they think about the deal, right? So, and in some cases, the timing for this can be very open-ended. It can be, 2 weeks, or it can be 3 months, depending on how easy or how difficult the Works Council is. So it's important to kind of get out in front of that process, have your story together on when you convene the Works Council meeting, so you can tell them, how the transaction is going to benefit the employees, what the changes are going to be, and answer any questions that they may have. So our goal is always to have the initial consultation such that we could actually take a vote at the end of it, and that we won't end up in a situation where they say, thanks for the presentation, we're going to think about it, and we'd like to schedule another meeting next month, right? So what you want to do is have clear talking points put together, and we've also worked collaboratively with buyer and seller so that we both present at the meeting, and getting all that stuff out there in the open hopefully gets you to a point where you can get the approval at that first meeting or shortly thereafter.
And Works Council is a whole other area we're going, particularly into Europe, right? It's so important from the outset to figure out how you're going to be dealing with Works Council. And the process will be different. Sometimes we think that Europeans sort of came together and within the EU everything is the same. It's actually not. and Works Council process in particular is significantly different from country to country. For example, in Germany and in the Netherlands, you can actually sign agreement, then go and do your consultation with Works Council. In France, it's a criminal offense to have an agreement signed, right, and only then go to Works Council. So if you sign an an executed version of the agreement for the sale of the business and you did not go through consultation, people who signed an executive of the business are going to go to jail in France. Yeah. So need to be extremely careful, and that's where it's so important to focus on these things up front. And again, Works Council may be simple or it may be complicated. Yeah. And as Brian said, most importantly, in most of these jurisdictions, you actually do not have to do what they're telling you they want, but you need to go through the consultation process.
It's always better to start out with a thumbs up vote versus a thumbs down.
Right, exactly.
Right?
Exactly.
Well, I think on the Works Council too, if your plan is to get rid of some of the employees, right, you're going to have to work through the Work Council as well, right? And it can elongate your process to offload those employees post-close.
Right,
yeah.
right. John, so maybe can you talk a little bit about, so Works Council is one, it's sort of legal, but it's also a cultural difference, right?
Yeah.
But switching to some of the maybe a softer topic like cultural differences in doing cross-border deals, what would you say, your experience in doing deals in different parts of the world?
Yeah, I think it surprised me how much passion that the employees have for their businesses. At least our experience has been that even employees who don't make a lot of money have a lot of passion for the company, and so we've had to be really careful in the degree we integrate. The German company we acquired, they were resisting against even basic sort of new email, new ERP system, let alone changing anything else on their business. So I think it's important to really think about how much the people care about their business and the owners as well. So I think that's...
Yeah. Brian, in terms of negotiation process and generally, buying, sometimes in Europe you run into these family businesses that have been around for a couple centuries. Yeah. What's the dynamic there?
It takes patience, and in one instance, it was probably a year and a half before we got to the meeting that I got to go out to negotiate the terms of the deal. Right? It was just getting the sellers to agree to sell. So it was 4 or 5 trips over there with our business development and our operations folks, just cultivating that relationship. Before we got to the stage that they were ready to sign up the deal. And then even then, I think when you're dealing with a family seller that's had the business for many, many years, what people say is, hey, this is market, kind of goes out the window, right? And you're going back and forth, well, we think we should have a 10% holdback. And they say, no holdback. And he says, do back and forth forever. And so you do have to make, I think, some judgments there, because if you really want this business, that they're not going to let go of it unless they get the right deal. So it's an interesting dynamic there, and a lot more face-to-face negotiations than we'd have. At my old law firm, we probably did deals 10, 20, 50 times that size, just over the phone and email, right, exchanging drafts. Whereas here, you're sitting across the table, for a couple hours, going through it line by line, and sharing a meal with everybody afterwards. So it's a much more social process.
Right. Scott, and how about Asia? Your experience, China, Singapore. You lived in Singapore. What's the Asia negotiation dynamic, deal dynamic, overall cultural issues that you've come across?
Yeah, it's interesting. I mean, I think that it's sort of a built-in irony in the sense that Brian was talking about, sort of the face-to-face, across-the-table negotiations in Europe. And you still have that in my experiences in Asia, but at the same time, a lot of the issues actually get done behind the scenes because there's a lot of, there isn't as much, I think, tolerance and value in direct conflict in terms of negotiations. So a lot of times, there's a lot of positioning that goes on behind the scenes, and that's where, again, the use of local advisors, particularly in the financial area, has helped us be very successful in the work that we've done there, is trying to manage that dynamic in a couple of different buckets. And also, I think the pace. The one thing I have found too is the pace there in Asia tends to be as fast the U.S., if not faster at times, setting aside the regulatory issues you have to deal with. But in terms of dealing with in arm's length transactions, I found that the pace and the willingness to move quickly is there as opposed to certain other places. And also just the issues of I think some of the differences in terms of how the transactions are documented, not nearly as much documentation, very light on that, and light on a lot of details. So it's been there's been certainly in my experience with my clients, there's been a lot of hand-holding, a lot of change management that's had to go on to get people comfortable with how we were going to make those investments and go into business with those counterparties.
Brian, your experience in Asia, anything interesting?
I guess the one thing that, from personal experience, a lesson learned really is that it's always important to know kind of who the decision maker is when you're negotiating an agreement. And we find that it's been a little more hierarchical, and there's certain cases where you think that you've agreed on something and you'll say, okay, move on to the next point. When it turns out you get the next version back and it's completely different, and then you learn that okay means we're thinking about it and we've got to go back and check with the chairman versus this is what our deal is. So it's
I've seen quite a bit of that as well. So sorry.
No, that was all. Yeah.
I've seen that quite a bit as well. You negotiate for a week and you think that you've made a lot of progress. Mm-hmm. Then all of a sudden they come back on Monday and say, this is good, this is good, this is good. We're like, well, but this is what we gave, right? And everything else is not good
right.
because
Exactly.
the hierarchy did not approve it.
Exactly.
How about Latin America, Africa? We don't have a lot of time and huge continents, right? But any interesting experiences in some of the less developed economies? Scott, Africa.
I've done a couple transactions in Africa, a couple in South Africa and one in Morocco, and in both circumstances, obviously there's a very big difference between North Africa and South Africa, but a much slower pace, a lot of diligence that had to go on in those markets that slowed the pace of the transactions down, trying to understand the parties, the structures, trying to get the counterparties comfortable with the structure we were proposing for acquiring their business and getting it in place. So it was a lot of educating not only of some of the local advisors, but also the counterparties themselves, which I think tended to slow things down and also tended to make it a little bit more complicated. And then also, from a government and regulatory standpoint, just that can be very challenging depending on the market that you're in, not just from the actual for example, like a MOFCOM version of MOFCOM in South Africa, but just the general government itself and its view towards multinational investment tends to also create another work stream that you have to put in place in terms of getting the government comfortable with what you're looking to do.
Yeah, and my experience in Africa and Latin America also is that the government involvement, whether it's formal regulatory approval or just government there behind the scenes, is something that we need to be very mindful of, because in some countries it's actually it's a good process, and maybe there are some regulatory approvals that are a little bit tougher, but overall it's a process that we would be accustomed to or at least comfortable with. In some countries you can actually get into serious strong arming and getting pressure from the government to do things that we're actually, well, there are some things that we will never do, right? But there are some things that it's actually truly putting pressure on the foreign investor coming in. And in some countries, one deal in Latin America a couple years ago, we had a couple $1 billion at stake, and we had a standoff with the government for 12 months, and then ultimately got to a settlement, and it was good outcome for the European client we were representing. But that dynamic puts a lot of pressure and a completely different spin on the entire transaction.
And absolutely. When you've got a counterparty who knows that that's another way to leverage,
right?
Who's got those connections, another way to leverage pressure on you to either increase a price or other conditions. It's a big challenge if you want to stay in that market.
And sometimes, and this goes, goes probably in a lot of developing countries. Some things you can take for granted, some things you cannot, right? Some things you can take at face value, what people are telling you. Sometimes you need to really ask serious, deep questions. We don't have the time to talk about corruption and what kind of corruption diligence you need to do, right? But in some of these jurisdictions, you need to be very, very careful, because one thing is that they're doing, right? And so you may not want to just get anywhere close to that business. What's even worse, you buy that business and you don't know that it actually was happening, right? Or you were not paying attention. Then we are on the hook, right? The company,
Correct.
the buyer that came in, the multinational, is on the hook in the U.S., on the hook under the Bribery Act in the U.K.
Right,
and
exactly.
a whole range of other in other jurisdictions. We are running out of time. If I were to ask each of the panelists to say if there is one thing that you would kind of give as a suggestion, food for thought for the audience before we open for questions. Brian, any advice, any suggestion?
I would just say if you're doing a lot of these in-person negotiations on these deals, plan ahead and try to whittle down the number of open issues that you have. I mean, I never like to take a trip overseas when you have potential deal killer or walkaway points still open, because any leverage that you have kind of goes out the window once you're sitting there in the room, because they kind of all know that my boss wants me to come back with a deal, right? And so if there are things like that, make sure that you get them taken care of before you book your flight.
Scott?
I would just say the two biggest things for me are the right team on the front end, understanding the resources you're going to have on your team for that particular jurisdiction, both here in your home market as well as in that market, and also setting the right expectations about timeline and understanding what that's going to look like and build your strategy on the front end of that, taking into account some of the complexity of those markets. So it's really about team and having local expertise in that market that can help you and setting the right time frame.
John?
Yeah, I think what's been important for us is having the right legal counsel, and in our instance, we've had to use financial advisors as well for diligence, even for small deals, just because the accounting is different and the financials are not as mature as we'd expect. So it's really lining up the right advisors to help you get the transaction done. And then on the back end, just if you have a culture of aggressive integration, I think you'll need to reconsider how aggressive you are if you've bought a company from overseas, or at least in the early days.
And on my end, I would probably say be mindful of mirroring as a psychological matter, right? We're all human, accustomed to think that what our experience is, that's the way it is in other parts of the world. It's not, right? And so avoiding mirroring, which means go back to the basics, right? You come into the country or culture you don't know about, go back to the basics, and sometimes ask whether it's local advisors or it's business people, ask the most fundamental basic questions that you would never think asking doing a deal here. Ask, because you will often find that the answer is different from the way you would expect. With that, happy to answer questions. I think we are almost out of time, right?
I have one quick question. So you've spoken a lot about deal structure and conditions and lockbox versus closing accounts, et cetera. What thought do you give to dispute resolution mechanisms? Because I find that we have the most beautiful agreements. You've gotten the client comfortable with all these foreign concepts and processes, and then at the end of the day, you may have UK law, Singapore arbitration, but ultimately, are you giving thought to, if things go south, where you are, and what sort of mechanisms, and if there are any tips that you have on that? Because I find that's something that it's always on page 95 of the agreement. Right. It's an afterthought.
Nobody reads that far.
Right. No one reads that far.
I'm happy to tackle and guys contribute. A lot of thought actually goes into it. The deal that I mentioned where we went into arbitration, 3 years in arbitration, it was English law, ICC arbitration. Panel consisted of 2 former UK judges, 1 former US judge. Generally speaking, the way we look at it is that for cross-border deals, the 2 legal systems that are most used, it's either New York law or it's English law. Some of it, where it's New York law, English law, depends really in which part of the world you're doing it. So in Latin America, it's going to be likely New York law. In Asia, it's about 50-50 between English law and New York law. in continental Europe, you actually very often would find that unless it's a pure local deal where you do it, or it's a public deal where you have to do it under whatever German or French law, you may find yourself doing under New York law. Those two, I would say, are more likely to be the governing law, right? In terms of the dispute resolution, it's actually an interesting question because sometimes what we found was in jurisdictions where we would have thought we will just rely on local courts, the advice we got was not. So I'll give an example. We were doing a deal in Finland, and we are working with our co-counsel Finnish firm, and we are saying that, well, you know, Finnish courts, right? It's a developed economy. There is no reason not to use Finnish courts for dispute resolution. And our Finnish lawyers are saying, no, don't, because it's going to be too long, it's going to be too complicated, it's going to be too bureaucratic, let's do international arbitration. The answer that going to mirroring, I would not have expected by any measure, right? Whereas in some other countries, actually, you know, our experience in Chile, for example, with Chilean courts was very positive. Not necessarily that I would say, let's put in a cross-border agreement Chilean courts as the courts to solve disputes, but I would say from my own experience, Chilean courts were actually very good, very fair. You know, process was streamlined. But you know, maybe guys, what's your experience?
I more often than not, I would say 9 times out of 10 would go for an arbitration offshore in a neutral jurisdiction with neutrals, you know, negotiating who the neutrals were going to be or the characteristics of the neutrals, along with certain rules that would apply to that. And that's where we've been most comfortable, both at McDonald's and at my current company, just in terms of, you know, the uncertainties around the local legal structure. Particularly in Asia, we pretty much always opted for an arbitration, ICC arbitration in Singapore with neutrals from different jurisdictions. In English law, I think almost 9 times out of 10 we had English law apply. And we ultimately I had a deal fall apart there with an Indonesian partner where we arbitrated in Singapore over that for it was probably a good year and a half. And you know, arbitration presents its own challenges, but I think it creates a little more certainty than having to deal with a local court, particularly in some of the Asian jurisdictions, in particular when you're a multinational. So.
Similar experience. We sold a business in Japan and South Korea last year, and I think our advisor's advice was to use arbitration as well. And I think partially, too, it's almost just from the perception, it just seems to be, you know, less confrontational, having it in there, you know, an arbitration clause versus a, you know, resort to the courts. And you know, we hate to go to court on these things if we can avoid it.
Right.
So I think by having an arbitration clause in there, it's just maybe it's, you know, mental, but I just think it gives the parties an opportunity to say, hey, let's work this out, so we don't have to invoke either one of those things.
And it also helps depending on the level of sophistication. I mean, if you're dealing with you know, IP-related disputes, I mean, you're going to need a sophisticated jurist in order to understand the issues and really look at it the right way. So I think it also helps depending on the subject matter of the business that you're dealing with.
Any other questions? If not, thank you.
I think that was an excellent session. Please join me with a round of applause.